Hello everyone, thanks for checking out my video. The tech-heavy Nasdaq rose to all-time high last week as investors piled their money into major tech stocks ahead of their earnings. The highlight of last week was none other than the 22% pop in Tesla's share price after the company reported better than expected performance. And that was the best day for the company in the stock market for more than a decade. With Tesla laying the groundwork and setting the benchmark for other Magnificent 7 companies, it will definitely be an interesting week ahead as investors will get the quarterly earnings from 5 of the Magnificent 7 megacaps, namely Meta, Microsoft, Alphabet, Amazon, and Apple. To add on to that, as the US presidential election approaches, I think investors must be prepared for higher than usual volatility and huge swings in the market. As always, watch on this video to find out more as I discuss these topics in detail. So last week was a relatively rough one for the stock market as compared to the previous weeks. But the choppiness did not keep the major tech companies down as investors pushed mega cap stocks higher in anticipation of a packed earnings schedule. Part of the reasons could be because Tesla's better than expected numbers had rekindled some optimism of investors that the Magnificent 7 rally is not over yet. Tesla was a beast after it reported its earnings on Wednesday. Basically, one day after the earnings date, which was 24th October Thursday, the share price rocketed more than 20%, clocking its best day since May 2013. And in the process, Elon Musk's net worth was lifted by roughly $26 billion. Not just that, the rally continued the next day on Friday, with the share price rising another 3.3%. That's more than 25% jump in just 2 days. Impressive. On the very same day, all the rest of the Mag 7 companies rose as well, ranging from 0.3% to about 1.5%. Notably, Nvidia has overtaken Apple as the world's most valuable company again, with its market cap hitting $3.5 trillion. Alright, for the upcoming week, earnings from the Magnificent 7 and a few other mega cap companies will be stealing all the headlines. So on Tuesday 29 October, Google will be the first Mag 7 companies to go first. On that day, investors will likely be keeping an eye on AMD's earnings as well. A strong earnings will likely push other chips companies higher, especially Nvidia. Another company to watch for that day would be Visa. Then on Wednesday 30th October, we have Meta and Microsoft reporting their results. Other notable names on this date includes Coinbase and Starbucks. Moving on Thursday 31st October, it's gonna be a busy day. For the earnings front, some of the big names to watch are Apple, Amazon, Intel, and MasterCard. On the economic calendar front, the same day brings the release of the PCE index, which is the Federal Reserve's preferred measure of inflation. This data point will provide investors with fresh insights into the current inflation situation and the potential monetary policy decisions by the Fed. Finally, on Friday 1st November, investors will get the latest jobs report for the month of October. This is definitely one critical economic indicator that could influence market sentiment and Fed's policy outlook. Okay, with so many things happening, I would expect higher than usual volatility throughout the week, so buckle up and brace for impact. Let's now move over to the technical analysis segment. So in my previous video, I shared that if the MACD of SPY starts to curl down, then the RSI bearish divergence will likely play out, and SPY has a high probability of retracing back to 575. And SPY did exactly that. It went to 574.4 at one point last week. Anyway, the good news is that SPY bounced off the very first support Fibonacci retracement level at 575. It appears that it is currently going through a small consolidation phase, but things could change with big tech earnings and the US presidential election coming up. In terms of the downside, once again watch for that 575 support level. If it breaks, it will bring us to the next mini consolidation zone, which means SPY could potentially touch 567 where the next support level is. Okay, personally, I will only be on alert if SPY falls below the blue support line at around 562, because by going below that, it means SPY would have breached the 50 moving average as well as the 50% Fibonacci level. In case you don't know, the 50% Fibonacci level is one common point for the price to bounce if the overall trend is still intact. In other words, if it breaks, I would say SPY has turned bearish. On the other hand, for the upside, I think it's quite obvious that the recent all-time high of 586 shall be the target for the bulls. A break above it will likely see SPY going into the 590s range, and in the 590s range, I would expect some form of resistance coming in at 592 based on the Fibonacci extension level. Let's now jump over to Apple. So last week I shared 3 potential concerns or bearish signals. You can check out my last video for more information. Anyway, since then Apple fell about 1.5% last week. Okay, from this very point, if you are a bull, watch the area 226 to 227 closely. Reason being, this is a double support area formed by the 50 moving average and the first Fibonacci retracement level. On top of that, the MACD just had a bearish cross. Therefore, if this double support area breaks, I would expect Apple to touch 221 at least, with the MACD continues to curl down. At 221 is yet another double support area formed by the 100 moving average and the 38.2 Fibonacci retracement level. And if this level breaks as well, then we can say Apple has turned bearish. From here, naturally, the next target will be the 50% Fibonacci level and the little gap at around 216. On the other hand, if Apple's bullish momentum is still intact, it should bounce off those double support areas that I have just mentioned. When that happens, I guess the obvious target for the bulls will be the all-time high at 237. As Apple will only report their earnings later in the week on Thursday 31st October, I would expect Apple to stay sideways, probably between the range of 227 to 237 until the earnings date. After which, let's see which direction Apple is headed. To summarize, for the upside, the key level to watch is the all-time high at 237. For downside, the key levels are 226 and 221 areas. If either of the key level gets breached, then that will likely be the trend of Apple moving forward, at least in the short term. Let's check out the hot stock, Tesla. Well, 25% jump in 2 days. I don't think we need a rocket scientist to tell us that Tesla is very bullish now. It's literally rocketing to the moon. So the question we have now is, as the indicators approach overbought level, will Tesla come crashing down back to the earth? Okay, here's my take. Tesla still has room to go further up, but that doesn't mean it will continue to moon or pop like what we saw last week. And of course, we have to be mentally prepared for the downside as well, because this is Tesla, it's so volatile. So let's dive into the chart on what are the key levels to watch for the up and downsides. First of all, though the RSI indicator has shot up to overbought level, it still has some room to go. I mean, check out what happened in July this year. That was how overbought the RSI indicator can go. Interestingly, after that moment, Tesla came crashing down. Okay, just remember this, alright? We will talk about it again later. Apart from the RSI, check out the MACD and the volume. MACD just had a bullish cross, which is a positive sign. As for the volume, let's ignore the day after its earnings because it's expected that the volume will be high. But watch the second day after its earnings. The volume is still much higher than usual, which means buyers are stepping in aggressively. Okay, come this week, specifically on Monday, watch if Tesla can put another green candle on the chart. Ideally, if it can open somewhere within last Friday's candle and then closes above last Friday's closing price, that will then give us a very bullish 3 white soldiers candlestick pattern. When that happens, well, we could easily take out the July's high of 271 and charge towards the Fibonacci extension level at 277. If this can happen within this week, I think there will be more FOMO investors stepping in and shorts trying to cover their positions. And that will then propel Tesla even higher towards the gap between 280 to 289. Okay, before all the bulls get too excited, like I said, the RSI indicator is hitting overbought area and no stock can go up in this parabolic manner forever. and July's movement was one example. Tesla pulled on 7 green consecutive candlesticks before falling from the moon to the earth. Will that happen this time? Well, we don't know. But here are some key levels to watch in terms of the downside. First of all, watch that 244 level. That's the gap up and breakout level. If that breaks, then Tesla could hit towards the huge gap between 218 to 242. Okay, in my personal opinion, I think it's quite unlikely for Tesla to fill the entire gap in the short term. At the very most, we could fill part of the gap. Not financial advice, okay? Within the gap, watch for the level 232. This is a level where many things happened previously. It's either it was a gap up level, or a gap down level, or a resistance level. Also, it seems to me that from 232 to 238, there is little participation from the market. It's like either you stay above 238 or you go below 232. So watch this 232 level as a key support level. As long as Tesla stays above it, we are fine. Let's now move over to Google. Google has been trading sideways since mid-September. That's 1 month worth of consolidation, and it seems like the stock is waiting for the earnings before making the next big movement. Among all the charts that I cover, I would say Google is the most straightforward one. In terms of the downside, 3 key levels or areas to watch. First of all, pay attention to the 50 and 200 moving averages, especially the latter. I have shared on a number of occasions how strong and how important this 200 moving average is since Google embarked on this monster bull run that started in late 2022 to early 2023. From April 2023 till today, Google has only briefly fallen below the 200 moving average twice, and each time it rebounded back up strongly. Therefore, if investors don't like the latest earnings from Google and the share price breaks below the 200 moving average, the bulls have to be on high alert. Below 200 moving average, the 155 to 157 area has to hold, because if it doesn't, then it's pretty bearish for Google, and I would expect to see Google back in the 140s range again. So there you have it, 3 key levels. 50 moving average, 200 moving average, and the 155 to 157 area. On the other hand, if Google bounces off the 50 or 200 moving average, or perhaps even bounce off the 155 to 157 area, that's bullish, because we could have a bullish inverse head and shoulder pattern. For confirmation of this pattern, Google needs to break above the neckline at around 169. If Google does that, wow, I would say we could easily see Google at 180s range again. In case you don't know, an inverse head and shoulder breakout is pretty powerful. Moving over to Meta's chart. Earlier on, I shared that Google's chart is the most straightforward one at the moment, but in terms of the most interesting one, I would say it's Meta. First of all, last week I mentioned that if 577 breaks, we could expect Meta to hit 562, where the next support level is. Look at what Meta did. It retraced to about 562 and rebounded. I hope that can warrant a like button from you. Anyway, why Meta's chart is interesting is because on one hand it looks like there is a bullish bull flag forming, while on the other hand there seems to be this cute little mini bearish head and shoulder pattern as well. So which one will play out? Honestly, it's a flip of a coin, mainly because their earnings are just around the corner on 30th October, Wednesday to be exact. Okay, so here's the thing, both patterns that I have shared are powerful patterns, which means whichever one plays out, the movement is typically quite huge. I mean, if you have been following me, you would have known that I previously shared about Meta's bullish inverse head and shoulder pattern and how it could hit 600 by year end, which it did. Okay, so let's say the bearish head and shoulder pattern plays out. I would expect Meta to hit 549 at least, where the so-called take profit zone of 50% Fibonacci level sits, as well as where the 50 moving average is. When we hit 549, I would then think that the little gap might be filled as well between 544 to 546. From this point, the last line of defense lies at 536. This used to be a level of strong resistance, but has now turned into a strong support. So if it breaks, it's waterfall time for Meta. On the other hand, if the bull flag plays out, the sky is then the limit, which means we will likely take out the recent all-time high of 602.95 and probably charge towards 610. Let's now hop over to Microsoft. Microsoft appears to be resuming its uptrend with a series of higher lows, which is why I did not close my latest cash secure put on Microsoft that I said I made a mistake by opening this trade too early. Check out my last video for more information. Anyway, apart from higher lows, Microsoft displayed a few other bullish signals last week. First of all, the MACD had a bullish cross. Secondly, it broke free from the 50 and 200 moving averages. Thirdly, it went back up that blue uptrend line. Well, whether this bullish momentum can continue or not, I think it hinges on Microsoft earnings on 30th October Wednesday. If investors like their earnings and AI play, I think there is a high probability for Microsoft to touch 440 again. A break above the recent high of 441.85 will be very bullish, as that will naturally brings us to the 450s range. On the other hand, yes, I mentioned that there were a few bullish signals, but Microsoft is not out of the woods yet. First of all, last Friday's candlestick looks like a bearish shooting star pattern to me. So how do we interpret this candlestick? Basically, during the day, buyers were in control at a period of time as they pushed the stock price up significantly. But later on, sellers started to step in and the buyers couldn't hold their ground as the price got pushed back down to near the opening. Okay, before you go starting to short the stock, I have to say that this single candlestick doesn't guarantee a reversal, but it certainly tells us to proceed with caution. In terms of the downside, watch the blue uptrend line as well as the 50 and 200 moving averages closely. If Microsoft breaks all three after its earnings, that's quite bearish. I would then expect Microsoft to possibly head towards low 400s, maybe at least 406 where the 61.8 Fibonacci level is. Let's now move over to AI darling Nvidia. Well, Nvidia has once again hit a new record high last week. Honestly, I was expecting a bit of resistance to come in at 142, but Nvidia managed to hit 144. Nevertheless, it eventually came back down and is currently sitting below 142. So what does this mean? It means there is a bit of selling pressure at 142 to 144 area. For Nvidia to go higher this week, I personally think we will need good results from AMD. If investors like AMD's earnings, the market will likely bring Nvidia up together as well. When that happens, like I always said, at all-time high, it's uncharted territory. It's difficult to tell when will market makers start to take profits. On the other hand, okay, just a quick one, just wanted to share with the viewers that I have received my second ever paycheck from YouTube. It's not a lot, about 160 Singapore dollars. And so just like the very first paycheck, I have donated this amount to a charity organization. This time round, the money went to the Straits Times School Pocket Money Fund, which provides pocket money to children from low-income families to help them through school. The children can use this money for school-related expenses, such as buying a meal during recess, paying for transport, or using it for other schooling needs. As I don't come from a well-to-do family, I understand the importance of having that extra bit of financial support to get through school, and so I wanted to give back by contributing to this organization, hoping this could make a small, tiny little difference in the lives of those who need it. Anyway, back to business. Again, like I said, nobody knows how high Nvidia can go and when is the next meaningful pullback, but I would think when it comes, it can flush quickly. I mean, we have seen it previously. For example, back in late August and early September period, Nvidia plunged from 131 to 101. That was a 23% drop in 2 weeks. And from mid-July to early August, Nvidia fell from 136 to 90, which was a whopping 34% drop. You get the drift. Therefore, if the flush comes, Nvidia could easily hit 131 where the first Fibonacci support level is, but that's just a 7% drop from the current price point. If we really experience a waterfall in the share price, I personally think we can watch out for 123 and 117 closely. For 123, other than being the 38.2 Fibonacci support level, that is also roughly where the 50 and the 100 moving averages are. So if this 123 breaks, it's breaking 3 support levels. Below that, pay very special attention to 117. If Nvidia doesn't bounce from this level, it means it might be heading towards the blue downtrend line, and that obviously is bearish. Just one more thing to add, the MACD is sitting dangerously at a point where it is about to have a bearish cross. Honestly, if AMD disappoints, then I think Nvidia could fall along and we could potentially see low 130s or maybe even 120s range. But of course, if AMD shines, then the sky is the limit for Nvidia. Moving over to the options trading section, 2 trades to update this week. The first one is this cash secure put on Tesla that was sold on 12 September. The strike price is 190 and the contract expired last Friday, 25th October. The thought process behind this trade was pretty straightforward. First of all, Tesla broke out of the blue downtrend line. On top of that, it did a retracement to retest that trend line and then rebounded off it. Remember, I have shared about these 3 R's: retrace, retest and rebound. When this happens, it's bullish. On top of that, Tesla had been creating higher lows since the 5th August sell-off. With all this bullish signals, I stepped in to sell the put contract, which is a slightly bullish move. More information about this trade can be found in the video linked at the top. Anyway, since I sold the contract, Tesla has been very volatile. What's new, right? It basically went up to 260s range, plunged back to 212 and then shot back up to 260s range again. And on expiration date, which was last Friday, Tesla closed way above my strike price of 190. As a result, my contract expired worthless. Which means I got to keep the full juicy premium of $580 without having to do any further action. That's actually more than 750 Singapore dollars. Not too bad for a monthly side income. Okay, the second trade is a new cash secure put on Tesla that was sold last Friday on 25th October. The strike price is 220 and the contract will expire on 6th December. There isn't much technical analysis behind this trade. It's more of a momentum play where I aim to ride on the existing strong bullish momentum. As mentioned earlier, Tesla popped more than 20% after its earnings, and the rally continued into the second day with the share price up another 3%. This shows that a lot of FOMO investors are stepping in right now to chase the share price. Therefore, in the near term, the buyers should be more than the sellers, and given there isn't any major event for Tesla coming up in the next 1 month, it's quite unlikely for Tesla to plummet more than 18% for no reason and go below my strike price of 220 in the near term. Okay, not saying that it can't happen, but I think the odds are low. Just to add on, historically speaking, November has been a strong month for Tesla with a winning rate of 71% and an average monthly change of 9.8% since its IPO. With all this in place, my view is that the risk to reward ratio for this cash secure put is quite favorable to me. But oh, before I forgot, maybe there's one wildcard, and that is the US presidential election. If Donald Trump, whom Elon Musk is heavily associated with, doesn't win the election, it will be interesting to see how the share price will move. Okay, as usual, sharing some of my thoughts of the current stock market. So last week we saw the broader market taking a little break as the benchmark 10-year treasury yield surged to a 3-month high. This sudden rise in bond yields ahead of the US presidential election has exerted downward pressure on the stock market. The recent rise in bond yields has been partly attributed to increasing odds of a Donald Trump victory, whose policies such as imposing tariffs and cracking down on illegal immigration are perceived as potentially driving inflation higher. At the same time, investors are also showing a bit of cautiousness in purchasing bonds ahead of the election, as various US policies will heavily depend on which party gain control of the Congress. Okay, so why rising bond yields could cause the stock market to fall? In summary, or in essence, when bond yields rise, they create a headwind for stocks in general by increasing borrowing costs, reducing the appeal of stocks relative to bonds, as well as reducing the present value of a company's future earnings. On top of this, rising yields can also increase the expectations of tighter monetary policy, which may curb economic growth. When you add all this up, it often leads to declines in stock prices, particularly for fast-growing or high-growth companies. Alright, with all that being said, the rising yields appear to be losing momentum. Some analysts believe that the yields might have reached a near-term peak, as the recent surge was tied to the uncertainty around the upcoming election. With the election coming up in less than 2 weeks' time and with Federal Reserve continues to cut rates, the bond yields should ease. But overall, if you were to take a step back, you will notice that the market remains quite bullish, given that we saw 6 consecutive weeks of gains prior to last week, and the stock market is almost up every month this year. To me, it's perfectly normal and healthy for the market to pause and consolidate after a strong rally. Okay, so that reflects the broader trend. In the short term, however, I would expect the market to remain choppy and volatile as the US presidential election approaches, coupled with several mega cap stocks reporting their earnings this week. It's actually quite typical for the stock market to get a bit jittery and cautious leading up to elections. And to add on, large swings in the mega cap companies' share prices can significantly move the market. But looking beyond these 2 weeks, or rather after the earnings reports and the election, I would say interest rates, inflation and the overall economy will continue to be the primary drivers of the US stock market over time. Okay, that's about all for this video. If you found my content useful, do help to tap the like button and subscribe to my channel for weekly updates if you haven't. Thank you.